Hello and welcome to Pain Unfiltered, where we go in-depth into the interventional pain and spine world with some of the top key opinion leaders and executives in the space. We are your hosts, Dr. Patrick Buchanan and Dr. Timothy Deere for this Aspen podcast. Let's get started. Hello and welcome to episode 8, season 3 of the Pain Unfiltered podcast. I'm your host, Dr. Patrick Buchanan, and with me is my co-host, Dr. Timothy Deere. Tim, we have ISPN approaching this month in London. What are you looking forward to the most there?
Well, you know, Patrick, I was just down in South America at LAPS, and while I was there, I had so many young South American physicians come up to me and ask how they could learn about MIS and neuromodulation. So we actually decided to give all the LAPS attendees free attendance both in London and Miami, because I think we need to help our colleagues around the world. And I'm looking forward to seeing some of those folks there. And we had about 20 young folks in the first 5 years out of training there in South America sign up for the meeting. And we had about 100 say they're coming to Miami there. So these are people that really are hungry to bring new things to new parts of the world. So I do think that advocacy of that's going to be amazing. So that's what I'm looking forward to the most. And of course, seeing my friends, which is always a wonderful part. And lastly, I just love England. What a great location. And Dr. Alcasi there has done a fantastic job chairing the meeting. So can't wait to be there, and I'll see you there by Buckingham Palace.
Yeah, that sounds like an exciting time, spreading the word from where you started this in Aspen and West Virginia, then Miami. Now we're making it global in London. So great to see the growth, great to see the participation, and we're going to keep growing. We also want to thank all of our sponsors that have supported this Aspen podcast: Mainstay Medical, Saluda Medical, SPR, Spinal Simplicity, and Biotronic. Thank you. We do really appreciate all your support and making this happen with not only this podcast, but just with this society and organization as well. So, Tim, today we're going to switch things up a little bit and discuss the business of medicine. We had Justin Harvey on season 1 to discuss employment contracts, tax strategies. And today we have a very special guest to talk about how to build wealth and diversify. Kelly Castleberry is not only a close friend of yours, Tim, but also the managing director at Greystone Consulting. Thanks for coming on with us, Kelly.
And no problem. Thank you for having me.
So before we start, why don't you just give us a brief background and how you got to know Tim?
Sounds great. Well, Tim, I hope I don't embarrass you with this, but as you don't care if I say this, his father-in-law was one of my clients originally, many, many years ago. And he used to tell me, you need to meet my son-in-law sometime. He said, you guys are just alike. You talk fast, you work hard, you're great guys. You need to meet my son-in-law. And of course, I'm thinking, yeah, whatever. So fast forward about a year or two, 1998, I was training to run my first marathon, and I got a little bursitis in my hip. And my sister said, you need to go see Tim Deere. He's the best. So I'm like, okay, I've heard his name a couple of times now. I think I'll go see him. So I went to see Tim. He injected my hip, made me feel great. I was able to run the marathon, but I'll never forget to this day, his exact words were, and Tim, do you remember what you told me?
I do.
He said, the human body's not made to run marathons. Now,
how ironic.
everybody that knows you knows the rest of the story, but how many marathons, ultra marathons, Ironmans have you done since then?
Yeah, I was wrong. Human body's never like Kelly, but you brought it to me, so thank you for that. I appreciate it, and certainly been a fantastic friend ever since. And certainly your work in the finance world, both in West Virginia, but throughout the United States, you're a renowned financial person. So we're honored to have you here today with us. And I think a lot of our members, I wasn't at the Ipsos meeting this past weekend. I was in Chile. People came back and told me they were so depressed. Everyone was talking about, it was a great meeting apparently, but everyone's talking about denials and, cash flow and employee costs and all those terrible things that was so hard. And so I think the timeliness of this discussion about taking care of your finances, when many physicians are worried about the practice of medicine and patient access and accessibility to payment is really great. So I know you and Patrick talked about having you on the show. And, when we talked about this, no one could I think of better. And also you've been very involved with helping Aspen manage our funds in a compliant and great way. So Patrick, I think you made a great choice in bringing Kelly on board here.
Well, thank you. And I'm going to interrupt a little bit, Patrick, if you don't care, because I do want to go back to when he and I first started. So a little bit after that first marathon, 1999, Tim and I agreed we'd go running together, and we met on some Saturday afternoon, pouring the rain, crazy day. We ran 5 or 6 miles, and we've been friends ever since. And I've got to say, hanging around Tim, he was kind enough to compliment me with some of the accolades I've received in the financial world, but I got to give Tim a lot of credit for it because he's been a great influence on me both personally and professionally. He's helped me be better at what I do, helped me run a good business, and just been really fortunate.
That's
Nice.
great. That's what we're all here for, supporting each other, helping each other, no matter what aspect of our lives are. So thanks for sharing that, Kelly.
Yeah, no problem.
So let's
So
talk about a little bit more about what you do, and this pertains to everyone, not only doctors, physicians, APPs, but also the industry, industry side of it as well. So, once we have, our source of income, and once we start developing and we have some cash flow, let's talk a little bit about the asset allocation. What do you want? What do you recommend diversifying in? Talk a little bit about the different aspects of where we can put our cash.
yeah, great question. So the key is just getting started. And a lot of people ask me, they don't know really how to get started. The key is just starting to invest. And, people have a lot of times confuse the term saving and investing. Saving is spending less than you make, but obviously investing is what you do with that money. And that's kind of where I come in, what I try to help with. Most people, to me, the biggest decision that clients will make is how they're going to divide up their money in what we call asset allocation. And a lot of people think asset allocation is stocks, bonds, cash, but there's truly a fourth category. Wall Street calls it alternatives. I would probably say non-traditional. To me, alternative sounds like a negative word, if you will. But if you think about asset allocation being how much you put in stocks, bonds, cash, and alternatives, right now it's interesting times. And of course, we're taping this on September 17th, and the Federal Reserve just announced a Fed rate cut today. They just cut 25 basis points, first time they've cut in 2025. And they anticipate more cuts this year. But the stock market has run way up in anticipation of that. So a lot of people think maybe the stock market's too high right now. There's no arguing the stock market is a little bit on the expensive side right now, but the stock market has always been the best performing asset class, better than bonds, better than gold, better than real estate. Always has been, in my opinion, always will be. So it's never a bad time to get started. But to be honest, right now the stock market is a little bit ahead of itself, and I do think we're probably due for a little bit of a breather. I think a little 5 or 10% correction probably wouldn't be a bad thing right now. So if you do get that kind of opportunity, I would say use that as a great opportunity to put more money in the stock market because there are some good things to be positive about right now. The three biggest influencing factors on the stock market, in my opinion, one would be fiscal policy, and that's taxes and Congress spending. Well, they've already passed the one big beautiful bill. Whether you're in favor of it or not, it's already in place, and we already know what tax rates are going to be for 2025, 2026, and beyond. So I think that's going to be a tailwind for the market. The Fed just cut. They announced that they'll probably cut more. And again, I don't want to get political, but it's almost a given that between now and next May, when Trump is able to appoint the next Federal Reserve Board chairman, we're going to get more cuts. So a year from now, we'll be sitting with much lower interest rates. I think that's going to be a tailwind for the stock market. And then the regulations out there in a lot of industries are going to either be reduced or go away. So that'll be a tailwind for the stock market. So again, I'm cautiously optimistic, but I'm always bullish on the stock market. So I say put more money there. Bonds are hard to get a little bit excited about. That the next tranche of your next piece of the pie of asset allocation. Bonds are a little bit hard to get excited about because we have what's called a negative yield curve or an inverted yield curve. The 2-year Treasury right now pays less than what you can get investing for overnight. So it's kind of hard to get excited about there, but if you want to make good, safe investments, and sometimes Tim will say, hey, I want to be safe with this money, we'll obviously think about bonds. So you do that a little bit. Cash right now is still paying pretty attractive rates, but again, with the Federal Reserve cutting rates and continuing to cut rates, that's going to come down even further. So, it's hard to put a lot of money there. So I say, you only leave in cash what you need for emergencies and opportunities, and the rest kind of think more longer term. And then the last category is alternatives. And, you and I kind of talked about those a little bit prior to the call. But that to me is where, if you remember the old Wayne Gretzky saying about skate where the puck is going, not where it is now, I think alternative investments are. And so I've been in this in the business for 35 years, been a long time. And I can remember in the early days of my career, you had to be a sovereign wealth fund or a foundation, a large foundation or endowment to invest in these, what I'll call alternative investments. But now they've become what I'll call democratized. They're available to smaller investors, people that can invest in them with smaller amounts of money. Um, there's a lot of areas that can be considered alternative investments, and a lot of them I'm not an expert in. Tim will tell you I'm not an expert in Bitcoin because he asked me about it decades ago, and I didn't know it. I wasn't smart enough to tell him to put all of his money in it. He reminds me of that all the time, as a matter of fact. But in our world and what I'll call the financial asset world, I divide alternative investments up into 5 categories: private equity, private credit, real estate, hedge funds, and infrastructure. And there probably would have been a time when I would have lumped infrastructure and real estate in together, but it's not arguable that this country is going to spend trillions of dollars on infrastructure in the next decade. And that's not just the old fashioned roads and bridges and all the kind of stuff that people think about as infrastructure, but power transmission, power generation, data centers, our water supply. There's just so many areas in our country that are antiquated, and it's just not arguable. We're going to spend trillions of dollars in that space. So if you want to kind of think about where things are going, obviously things like artificial intelligence and data centers are going to drive demand in that infrastructure space. Also, private equity. 80% of all the companies that make over $25 million are still privately held. So if you're not investing in private equity, you're missing out a large opportunity set there. I'll just give this little factoid. When I started in the business in 1990, there were 7,000 publicly traded companies that traded on the stock exchange. Either one of you guys want to guess how many stocks trade publicly today?
7,000, I'm guessing.
3,500.
Okay.
It's half.
Wow.
So
Yeah.
there's fewer opportunity. And the reason being is you can access the capital market so much easier for a private company than you used to be able to. So if you can get capital through either private equity or private credit, why go public? Why go through all the scrutiny of going public? So there's just so much of an opportunity in the private equity space to invest there. Private credit is direct lending. That kind of came about as a result of the great financial crisis. It changed how much money banks could lend, who they could lend to, how much, what they had to keep in reserve, and so on. So it kind of created this cottage industry of what I'll call non-bank banks, or the shadow banking system, as Jamie Dimon at JP Morgan likes to refer to it. But the private credit market out there, great return potential, and I would say there's no more risk than there is in the public credit sector. So I think you're talking about. I talked earlier about the 10-year Treasury paying about 4%. In private credit, you can probably get more like 8 or 9, maybe 10%. So why not get that extra layer of return? So in that,
let me ask you a question though. So I think a lot of our listeners will be confused a little bit.
sure.
I'm not sure we understand what private credit versus private equity is. And you talk about 8% versus 4%. How do you even get involved in private credit or private equity? If you're a physician practicing in let's say Orange County, California, where some great doctors practice, and you say, okay, man, I've got a lot of investments in stock. I want to get in private credit or private equity. How do they make that jump? How do you get in there? And can you explain what both those are exactly?
Sure thing. Well, to kind of keep it simple, like I said, back in 2008, when the financial crisis happened, they changed all the rules that banks had to follow. And again, how much they could lend, who they could lend to, how much you had to keep in reserve. So these asset managers, large asset managers, and it's the names that most people are familiar with: Blackstone, Goldman Sachs. A lot of people haven't heard of Ares. Ares actually happens to be the largest. KKR, Colbert Kravis Roberts. They all came out with these pools of assets where they would lend money to small, medium-sized businesses. It's called direct lending, where businesses would come to them versus going to a bank. So let's say you're a business. Let's say you're a auto parts manufacturer in the Midwest, and you're too big to go to the local community bank, but you're too small to go to the great big money center banks like a JP Morgan or a Citibank. You go to these asset managers and you say, I need a $20 million line of credit. And they say, okay, we're going to loan you money at the benchmark now is called SOFR, SOFR, Secured Overnight Financing Rate. It used to be prime. It used to be LIBOR. Now they've changed it to SOFR. And they're going to lend you money at SOFR plus, let's say, 400 basis points. SOFR right now is about 4.5. 4.5 plus 4% or 400 basis points would be about 8.5%. And you as this brakes manufacturer, you don't really have many other choices. You say, sure thing. So what private credit are these asset managers lending money, doing their own underwriting, doing these loans, creating these own loans, and you as an investor need to invest in them. Like I said, back in the old days, you would have had to have been Harvard's endowment or the Saudi wealth fund or something to get into investment like this. But now they're creating these what I'll call democratized vehicles where you can get in for as little as $25,000 or $100,000. I can remember when it was $1 million minimum, and then it was $500,000, and then $250,000. Well, now you're getting minimums in the $25,000, sometimes $50,000 minimums. They're creating these vehicles for investors to invest in these things to give more people access to more opportunities like this. Does that make
So
sense?
do you have to submit through an application for this? Do you have to be, qualified through a bank? How do you get into private credit?
Great question. There are three qualifying terms on Wall Street. One is called accredited investor. That's $1 million of net worth, or I think it's 300,000 in income. Don't quote me on that. The next is qualified client, which is $2.2 million net worth, and the highest is qualified purchaser, which is $5 million net worth. You go through any financial institution, like, you mentioned Greystone Consulting is the company I work for. We're a division of Morgan Stanley. You can go through a Morgan Stanley, Merrill Lynch, any financial organization, and you get qualified for these things. So they run what's called a Reg D to get you qualified. And based on your net worth and your income, you'll be qualified for different types of investments. And based on what you qualify for, that's going to open up a different opportunity set. So that's kind of how you go through that process, is start with your financial advisor and talk to them about what opportunities they have and what you might be qualified for, and just go from there.
What are some of the downsides to private equity or private credit? How long, you're talking about opportunity costs. How long do you have to be in these for? What is the risk of losing it all?
Yeah, another great question. In our world, I typically think of things as in three liquidity tranches: liquid, semi-liquid, and illiquid. Liquid are the things we do every day: the stocks, the bonds, mutual funds. Anything that I do in that world, I can sell and I can have you money the very next day. So that to me is very, very liquid. On the other end of the spectrum would be things that are illiquid, and that would be like the old-fashioned true private equity, private credit deals, where you would commit a certain level of capital, and it'd be like a 10-year deal, and you're not going to get your money back until they tell you. Then that's very illiquid. But now these things that I'm talking about now, this new structure, they're called interval funds, and they're semi-liquid. So I think, one of the potential downsides is it's not quite as liquid as liquid investments, but you can typically get your money in 30, 60, 90 days. Most of these, what I'll call interval funds, you can get into them at certain intervals and get out of them at certain intervals. So one of the potential drawbacks is that. Second potential drawback I can think about is the risk associated with the investment. If you're buying a syndicated loan, it's probably had to go through a lot of government regulations and a lot of transparency. Basically, in this case, you're just betting on the company that's making the loans that they're doing the right underwriting. They don't want to lose money any more than you do, so I don't think that that's that big of a risk. But they are going to make a loan from time to time that's not going to pan out, so there might be some potential loss. But like, for example, and I'm not going to mention any particular fund, but one of the private equity vehicle or private credit vehicles, that we invest in, has over 700 loans. They've never had a single default in 10 years. So knock on wood, hopefully they don't have a default. They might have a stress situation sometime where maybe a borrower can't pay back, but maybe they can work with them and negotiate some more favorable terms and so on. But if you've got 700 loans in a portfolio, even if one or two goes bad or has some issues, you're not going to. I would think that wouldn't be a big issue. I mean, I would think that no single loan is going to be more than half of a percent of the portfolio. So even if one loan went to zero, it's not going to impact your overall returns.
Kelly, let me ask you almost shift the focus a little bit now. A lot of, let's say we have a member who's 40 years old, has two children, and they're doing well in their practice. They have a surgery center ownership. Things are going well for them. But they also have a condo in Aspen, and they go skiing a lot overseas, and they travel, and one day their spouse says, when are we going to be able to retire, and how much money are we going to have when we retire?
Yeah.
So can you give us just a very overview of the retirement vehicles your firm recommends, in generalities, and when should you start thinking about that as far as your investments go for retirement versus investing for college funds versus investing for the 60th birthday or the wedding for your daughter or son, so how do you prioritize retirement planning and investment?
Yeah. Okay. Great question. Well, as you know, I'm a big advocate of taking advantage of every investment opportunity you can. So, if you're a W-2 employee, I did listen to Justin Harvey's podcast. Thought he did a great job and talked about employment contracts. A lot of that stuff was new to even me. So I really appreciated that. But if you're a W-2 employee, obviously you want to take advantage of your 401k at work. You want to take advantage of investing outside of your 401k in an investment account. If you have some 1099 income that you could shelter, maybe you look at that one person 401k or a SEP IRA like you and I've talked about in the past, Tim. So you take advantage of every tranche that you can, every bucket you can, try to get all the tax advantages that you can. This asset allocation I talked about, that's fine for, each individual in each individual bucket. But at the end of the day, what you want to do is build this pile of money, and it's going to do one of two things. The bigger the pile of money that you save, either you'll get to retire sooner or you'll live a higher standard of living when you do end up retiring. So the answer to I've had that people ask the question, and everybody asks the retirement question a different way, but it really all boils down to the same thing. Some people say, here's how much money I have. What can my retirement income be? Some people say, here's how much income I need. When can I get there? Or some people say, how much do I have to save between now and then, whatever. It's like I said, it's a variety of questions. But I think the key is for everybody to think about what their expense needs are. And then we need to build a big enough pile to be able to generate that much income. So again, I don't think there's going to be any two clients exactly alike. But once they figure out how much it costs them to maintain that home in Aspen and maintain that travel and put their kids through college, figure out what that number is, like what their quote unquote number is. And I need to figure out the best way to get them from where they are today to get to that number.
Wow, there's a lot of great information, Kelly. You talked about different assets you can invest in as well. You mentioned private equity, private credit, stocks, bonds. Where does real estate come in this? And you also mentioned infrastructure. Wow, how would you get involved in any of
Well,
those?
so real estate obviously is also another great investment category. It gives you a great hedge against inflation, can provide you some income. There's probably a lot of different ways you can do real estate. A lot of people want to do real estate by investing in it directly. So if you want to do that, that's perfectly fine. We also offer investment vehicles that are real estate specific, and it might even be specific to a certain sector. So for example, we're raising money right now for companies that do nothing but build data centers. So if you want to be in that space, we can invest in the data center world. We have investment vehicles that are nothing but commercial and industrial real estate. So warehouses, like, Tim flies all the time. I know he flies in and out of Atlanta. When you're coming down into Atlanta, you see all those warehouses and distribution facilities. Somebody owns all those. So we can invest in vehicles that buys things like that. So, you might live in Southern California and that's a great place to live. And you might want to invest in that real estate, but you're like, I want to diversify outside of Orange County or whichever county you live in. So, we can invest in those type vehicles as well. So I think about real estate in a lot of categories, but right now the hotspot seems to be industrial and data centers, multifamily housing somewhat. There was even a time when Blackstone, the largest alternative manager in the world, was going around buying up entire neighborhoods. I think some states even passed laws that Blackstone had to stop buying real estate because they were buying up all the single family homes and trying to rent them to people. So a lot of areas in real estate you can get involved in. And I do think that's an important piece of somebody's portfolio.
Okay, let me ask you, great thoughts on that. Thank you for that. So, you and I have had the opportunity to know some professional athletes in our day, and, many of whom made a lot of money. We've also had the opportunity to know a lot of physicians who made a lot of money and ended up broke, and struggled.
Yeah.
What are some of the advices you have? Give us some advice on avoiding pitfalls that makes you, although you made a lot of money, you spent a lot of money, and now you have no money, and you're getting older now. So how can someone avoid that? How can you avoid financial ruin when you have an opportunity for financial stability?
Yeah. Well, another great question. I don't know that I'll be the exact expert to answer, but you hear too many times about people that spend money that they either don't have or more money than they should be spending. Like I think about the professional athletes you talked about, they think that income's going to last forever, and obviously it's not going to last forever. And then, hate to put doctors in this category, but I'd say, you're probably pretty good targets for people that aren't honest and ethical. And I think they bring investment ideas to your all's attention, and it sounds like a great idea, and you put money in and it goes to zero. And I think, avoiding those kind of mistakes and catastrophes. So don't invest in more in something than you can afford to invest, and don't spend more than you have coming in, but just try to keep it simple. Like, I know I talked about a lot of things, and I know I talk really fast, and I know private equity and private credit sounds complicated, but just invest money. Like I was trying to have that conversation with somebody. People, they always want that next hot stock. Like they want to know what the next Nvidia is going to be or whatever. And that's great. And maybe we can find that, but just put your money in things and invest it. Because if I come to you with what I think is the greatest idea in the world, if you don't have money to invest in, it's not going to do you any good. So I think, the key is, Tim, just doing it, just putting your money away, putting it aside, keeping it diversified, good asset allocation, good diversification. Justin mentioned it before. There are doctors that like to do it themselves. That's perfectly fine. Some doctors would rather spend time doing other things, and they need a financial advisor. So, work with someone you can trust, and like Nike says, just do it.
Great.
That's great, Kelly. As we wrap up this episode, you mentioned 401ks and SEP IRAs. What are some other tax strategies that we can save on other than retirement plan contributions?
Yeah, great question. The tax bill that they just passed kind of made permanent some of the tax laws that they passed back in 2016 in the first Trump tax bill, and now they call it the One Big Beautiful Bill. And one thing they did was made it harder for people to get tax deductions. They took away a lot of deductions. They made phase outs for people at higher income brackets, and they doubled the standard deduction. So a lot of people, it's just easier for them to take the standard deduction. And they really only left three. And again, if someone has their own LLC or C Corp, possibly there's other things you can deduct. So I'm not going to get into that like Justin did. But for the average tax-paying person, they really only left you three things that you can deduct. Number one was state and local taxes. Number two was mortgage interest. And number three is charitable donations. One of the problems with it on the state and local tax part, they call it the SALT deduction. And Patrick, you're going to be a perfect example of this. Living in California, you probably pay a lot of state and local taxes, but it doesn't matter how much you pay. They put a cap at $10,000. So married, single, didn't matter, $10,000. Now, the One Big Beautiful Bill actually increased it to 40, and I can't remember if that kicks in 2026 or 2027, but you are going to get a little bit of relief there, since I'm sure you pay more than just that $10,000 in state and local taxes. But for the average taxpayer in 2025, they get that first $10,000. I'm going to say your listening base, maybe some have mortgages, some don't, but you get to deduct that mortgage interest, and then you get charitable on top of that. But the standard deduction doubled to where for some people it's between $25,000 and $30,000. If you're older, it's a little bit more, and so on. So I'm going to say it's a range. Let's call it $30,000 standard deduction. So if you had $10,000 in state and local taxes, let's say you had $10,000 in mortgage interest for the year, unless you made more than a $10,000 charitable donation, you're really better off taking the standard deduction and not trying to itemize. So one thing we talk to a lot of our clients about are what I'll call lumping gifts all at one time. So maybe if you're philanthropically inclined, or if you have some charity in mind that you want to support, we can lump multiple years worth of gifts into 1 year. And yes, you can give it directly to the charity. But Patrick, one thing you and I talked about that I wanted to make sure the listeners were aware of was something called a donor advised fund, where you can deposit money into that fund, and you get the full market value of the deduction off your taxes in the year in which you deduct it, but then you can use that as a bucket to give money out of for years. So if you happen to have maybe a big income tax year, maybe some windfall of profits, and you can do something, you can set aside some money in that donor advised fund. You get the full deduction, value of the gift that you made, but you get to use that as a bucket to give money away for several years, or maybe even forever potentially. So if people are out there looking for more ways to save taxes, yes, I want you to, fund your 401k, fund the SEP IRA, and so on. But pretty soon you start running out of ways to get some tax deductions. And I just think I don't want people to overlook charities as a decent way to offset some taxes.
Okay, let me ask you, I have two final questions for you, and then I'm sure Patrick will want final thoughts. So let's say I have 4 children. Now I have a grandbaby, Sophie. So if you leave a lot of money to your children, what's the tax limit now for how much you can give to your children without them paying a huge tax on the inheritance? I've heard stories where people gave their home to their kids, but their kids had to sell the home anyway because they couldn't afford it because the tax burden was so high. Right. Or, if I have a relative who has a big art collection, and say they gave that to one of my children, again, paid the taxes are pretty heavy. So what's the amount of money you can give to your children, grandchildren, without a huge tax burden to them?
Another great question. So just in simple terms, we were really worried about it last year because we were worried that they wouldn't get the tax bill passed, but they did. And they basically made the current situation permanent. They actually increased it. So the dollar figure that you're referring to right now, the estate tax credit, is this year it's $13.99 million per person. So call it 14 million. So a married couple can pass $28 million. There's an unlimited amount you can pass between your spouse. You could leave everything to your spouse, or they can leave everything to you, no taxes. But $28 million for a married couple. It's going to go up to $15 million per person in 2026, and it's going to go up from there based on inflation. So the good news is a lot of people, the estate tax credit, or the estate tax, doesn't hit as many people as it used to. The flip side of that is The flip side to it is, though, you can't ignore it because you still need to do estate planning. Because really, to me, saving the estate taxes was like the icing on the cake. But the estate planning part is so important because you want to make sure the assets that you worked hard to build go to the people that you want in the time and in the fashion with which you want. So estate planning is still crucial, but avoiding estate tax is not quite so critical anymore.
All right, so I said I had two questions. That's a great answer. I think everybody on this podcast will be pretty happy to hear that answer. The other question, though, is controversial, it may be offensive to some. So, I mean, you may offend some people, but that's a good way to end, because it may get more listeners on here. So, right now, if you live in California or Illinois or New York, I've had friends who've had good investments that did well, who moved out of those states. They moved to Nevada or Tennessee or Texas or Florida, where I have a home. So, if someone came to you and said, "Hey, I can work in these two states," how big of an impact is it to move? I mean, would you recommend that people on this podcast listening today in those states who have a big windfall coming to them leave those states? What's your recommendation as an advisor?
Well, I'm not going to be able to answer that too specifically because I'd say it's going to be case by case. Probably Patrick could probably tell you about an advantage of living in California. Like I'm sure he likes the scenery and the weather and so on. Like we have some weather here, but
Yeah, I like to wear shorts and a t-shirt all year round, so
yeah,
Nice.
that works.
but taxes are important. People tell you don't let taxes influence your investment decisions, but you know what? They have to because they're a fact of life. So, when you're deciding on whether you're going to pay 15% tax or whatever Patrick has to pay in California, or like you say, New York or Illinois, some of those higher tax states. Here in West Virginia, we're fortunate enough. Our state income tax was at 6.5%. It's now lowered to just below 5%. So not quite so detrimental to a portfolio. But, when you think about living in a place like Florida that has no state income tax, then the trade-off is going to be property taxes and insurance and all the other things that they have. So I think you probably have to go case by case, but taxes are an important part of the decision.
That was an unfair question. Patrick, I'll give it back to you.
Thanks, Kelly, for answering all that. Tim loves to put people on the hot seat here in this podcast, so I appreciate it. But thank you so much for coming in, Kelly. We've had some great guests of Tim's come on here. We had a close friend of his, Matt Dixon, who's you probably know him as well. He's an Olympic running coach. We got him on last season. Talk about being your best self, and I thought that was super valuable to our listeners as well. And this podcast also is going to be really valuable to our listeners as well. I'm going to have to pick your brain after this, Kelly, too, with all this discussion. But let's leave this off, close this out with one of your personal experiences with Tim, something maybe we as listeners don't really get to know. I'd love to hear one good story to end this podcast.
I told a couple of them the other night. I don't know if I could retell any of those, Tim. What do you think?
Probably not.
Probably not. One of my favorite memories with Tim, he was running the Leadville 100-mile race, which it's probably the hardest ultra in the nation. It's done all at altitude, 10,000 to 14,000 feet in altitude. And I was allowed to be his pacer for the second half of the race, and I was running with him. And we left an aid station, and about a half a mile outside the aid station, he told me he was cold. And he said, "Would you go back and get my pants?" So I turned around and ran as fast as I could, got his pants, turned around and ran back, and I couldn't find him. I'd lost him. It was the middle of the night, pitch black, couldn't find him. And where I had left him, the course had just forked, and I was so worried he went the wrong direction. So I didn't know what to do, so I stayed on the course, finally caught up with him, and I passed all these people that I know were in front of us, and I'm like, "Have you seen my friend?" "Nope, haven't seen him." Finally, I run, and I just recognized Tim's gait, and I could see him up ahead of me. So I ran as fast as I could. I finally caught him, and I said, "What happened?" He goes, "I just started feeling better, so I started running faster, and I passed all those people." And he said, "And now that I've run faster, I'm not cold anymore, so I don't need those pants anymore." So
Yeah, and I thought a mountain lion, as it was Mount 85, I was hypoxic. I thought a mountain lion was actually stalking me, and I was scared. So I was running pretty fast because I was pretty scared. But that was a good memory. We survived that. That was good. One of many survival stories we can tell.
yeah, we've had some great.
That's awesome. Well, thank you again, Kelly, so much for coming on and spreading your knowledge. It's going to be very valuable to our listeners. And that wraps up episode 8, season 3 of the Paying Unfiltered podcast. Thank you guys for joining us.